Investment flash.
Nvidia just told the market what it wanted to hear, and somehow the dollar stole the show. Stick around, this tape is split in two.
Good morning. It's Thursday, August 27th, New York edition. I'm Marie, joined by Tom and Gerald. We're breaking down the day's signals: semis, tankers, rates, grains, and a rare earth twist.
Yeah, look, I'm already suspicious, because the first thing I see is Nvidia up after hours, and the semiconductor ETF still 17% below its high. The easy money's made.
Buddy, that's exactly the bull case. It's not priced for perfection yet. Nvidia sits around 15 times forward earnings, down 1.6% last session. And yesterday, we said buy Nvidia. Last night validated it.
But the validation goes beyond the headline. Nikkei says PowerTech is planning the first panel-level packaging for AI chips by 2027. That's not just demand, that's capacity architecture.
A 2027 packaging plan, that's just an analyst's Christmas list with extra steps.
Ha, that's brutal.
And that's where Taiwan comes in. The FT and Nikkei both flag stronger Japan-Taiwan chip ties and tariff refunds. If you want a proxy, TSMC at 19 times forward earnings is cleaner than the broad basket.
TSMC, ASML, Tokyo Electron, the whole equipment complex is up year to date, but still double digits from highs. That's not crowded.
ASML up 50% this year and still 13% below its high. It's not cheap, Tom. It's just not insane.
But look, Europe semis edged higher after Nvidia, and that's not a coincidence. This is an infrastructure trade, not a single stock pop.
Exactly.
Yeah.
That's the whole story.
Right, tankers. FT has a shipping boss saying the Iran war is drifting toward a Ukraine-style stalemate. That keeps freight rates at records, even as oil eases.
And that's all you need, buddy. Stalemate, not escalation. Scorpio tankers up 51% this year, 14% off its high. Still room versus Frontline.
Hold on, Frontline has doubled this year and sits only 9% below its 52-week high. The easy money is made there. I'm not chasing.
But the oil side is the split braid. The oil ETF dropped 5.3% on the week because diplomacy is driving, not war. If Hormuz talks succeed, tanker rates unwind.
Sure, but the freight rates are already booked. The shipping boss isn't guessing, he's seeing order books.
Right, but if the war de-escalates, rerouting demand drops. That's not a maybe, that's the base case risk.
Still, the trade only needs stalemate to persist. I'd rather own the tanker than the oil here.
100%.
That's it.
Nailed it. Now, the real story from yesterday, the dollar popped the most in nearly 4 weeks after PCE data boosted bets the Fed will raise rates by year-end.
And MUFG is already warning that higher inflation plus weaker European growth will push the euro down into Jackson Hole. That's the cleanest short, not just the dollar long.
So you're telling me the dollar index ETF is only 2% below its high? That's barely priced. I'm in.
Careful, Tom. The long-duration Treasury ETF bounced 1.2% last week and is still 10% below its high. That's where the repricing is less complete.
Look, if the PCE read is correct, shorting long duration is the expression. But the euro short is specific to a weak Europe, not a strong dollar per se.
I mean, I hate bonds anyway, but if the Fed's hiking, I'm not buying duration.
Funny. You've said that every cycle since 2019.
And I've been right more than the bond bulls.
All right, but the dollar's strength isn't free. The FT's column this morning asks whether the U.S. is gambling its role as the world's investment hub. That's the long-duration risk behind this trade.
As always, none of this is investment advice. Grains, then. FT warns El Niño is a recurring systemic threat to the food system. Wheat ETF jumped 5.3% last session to a 52-week high.
And corn hit a 52-week high too, up 2.3%. This is a weather premium with legs, buddy.
Not so fast. The article offers no new crop forecast. This is a supply shock trade without a supply shock yet. I'd own the grains over agribusiness equities, but not Chase.
Exactly. Agribusiness has less direct weather leverage, and at 2% below its high, it's a hold at best.
So wheat and corn, yes, but the machinery makers, skip. Got it.
EV showdown. Nikkei reports BYD will take its Japan-only mini EV tech to a new European model. That's battery and price competition aimed straight at Renault and Tesla.
Renault trades at 4 times forward earnings, down 23% this year. Cheap for a reason. The exact threat that keeps it cheap.
And Tesla, 160 times forward earnings, 31% drawdown. That's vulnerable to a proven rival. I'm actually bearish.
Hold on, Tom. You've been the Tesla bull since forever, but the math is what it is. BYD's cost edge is structural, not cyclical.
Fair point, but I'm not saying BYD kills Tesla. I'm saying the multiple leaves no room for error.
And this is a long-term competition story, not a one-model headline. Shorting Renault feels smart, but value traps bite.
See, this is what I mean. The only clean long here is BYD itself, because it's the disruptor with proven tech.
Rare Earth's twist. Varroc is developing a rare earth-free EV motor to cut China reliance. That's a direct hit to rare earth demand.
The rare earths ETF gained 3.1% this week, but is still 30% below its high. The threat isn't priced.
Exactly. And India's manufacturing story gets a tailwind. The India ETF is essentially flat on the week, but only 10% above its low. That's early, not crowded.
So long Varroc, long India, short rare earths. I like the symmetry.
One note, Varroc is a single development stage story. The India broader trade is safer than a single name.
And that's the structural lens. Supply chain autonomy from China is the multi-decade theme, but it's not a straight line.
All right, let's zoom out. The tape split in two. AI infrastructure is validated but already reflected. Semis up 49%. Nvidia near 15 times. The harder money repricing is the unfinished trade.
Right. The dollar index ETF is only 2% below its high. Long duration treasuries, 10% below. That gap is the story.
And the bear case is that every side of it is crowded. Tankers doubled, grain ETFs pinned at highs. If Hormuz de-escalates or Powell talks down PCE, the unwind hits the year's leaders.
The FT column makes that exact point. The US default overweight is a policy choice, not physics. The dollar's reserve premium priced at almost zero risk.
But what the press missed, nobody linked the dollar to EM carry. Emerging markets are up 19% this year. Asian central banks are quiet. If PCE is right, that's the next pressure point.
That's the elephant. The cleanest cross-cutting expression is long the dollar index ETF against long duration treasuries and long Asia semis over European autos.
So you want the dollar strength without the crowding, and the AI infrastructure without the already extended tankers or grains. Fair.
Exactly.
That's the whole trade.
Nailed it.
If you're just finding us, hit follow on Spotify or check investmentflash.com for the full digest with charts and sources.
We're back tomorrow for the London edition at 7:30 a.m. London time. See you then.